Okay, so what we're doing, we're picking up where we left off before, and we decided that the agenda that we would do is create some scripts based on the openstax textbook. I was going through and looking at it. It's pretty cool stuff. This openstax stuff makes me think it might be cool to make a whole course on YouTube just using this textbook. Anyways, for now, I'm going to just jump to making some explanations of each of the questions and exercises in here. I'm also looking through and thinking might be worthwhile to make a kind of a short explanation of each of the terms in terms of how it relates to the framework that I use. So I'm going to just do what I'm thinking without being able to really explain it. So, chapter 2 has these terms. If I wanted to explain what this term meant using my system, the accounting equation supposed to be using the PDF so that I can take notes. So, accounting equation. So, if I was going to do kind of a short saying, okay, what is the accounting equation? This is the accounting equation. Obviously, assets equals liabilities plus owner's equity. But what does that really mean? This is meaning whenever this is a integral to double entry accounting. The way I would graphically show it is the box diagram with the center line, each side balancing. So I need to be able to draw, so this markdown is not going to work. I think it has to be a slide. We're going to have to do a slide per So I think slides are going to have to be our basis of, or the method that we use to script things. I can use the notes. I don't really like that because it's hard to export it. I guess you can view it as just the notes. All right. Well, okay. So, openstax. Well, I guess we should name the book. Okay, I'll just grab this title. I'll put the website in. Okay, here we go. All right, whatever. Here we go. So, assets equals liabilities plus owner's equity. Meaning these two sides must balance. So, if you have 10 here, 7 here, then you know that has to be 3. Both sides have to equal 10. All right. So that's how we could go through which each of the terms. All right, so I'll go through and type all the terms out. So all these I need to make a glossary. I don't think that was right. I need these to be in groups. Multiple choice. All right, so we will Chapter 2, Question 1. So I guess it calls it 2.1. All right. So, which of these statements is not one of the financial statements? A, income statement. B, balance sheet. C, statement of cash flows. Or D, statement of owner's investment. So, with each question, we will say, what's my template here? I made a template where I'd say the question, say the choices, and then give the logic of each and discuss the solution. So for this one, it would be, well, there are 4 financial statements, 4 standard financial statements. So I'm going to actually, I want to Google real quick whether there's a list of the other obscure ones, like other comprehensive and there's the 4 basic ones, but where's the non-basic ones? No, I don't like any of this. All right, might have to just use chat. Okay, anyways, this is as simple as just memorizing what the 4 statements are. I like to draw them in terms of my graphic. Oops. So there's the balance sheet, which is represented by this 3 square. Balance sheet. And then I like to think of the income statement as a component of equity, showing the change. And then there's the cash flow statement, which takes all the cash flows and then describes them in terms of how all changes in cash can be attributed to inflows and outflows related to other asset purchases, in terms of liability and inflows and outflows to owners, and then cash flows in terms of operations. So we've got the balance sheet, we've got the income statement, and then what color was I doing? And then you've got a statement that's talking about the entire stockholders' equity. I think one thing to point out when we talk about the statement of stockholders' equity, that's different than common stock. You'll hear the term common stock. If I was trying to make this question trick somebody, I might say statement of common stock, or like they did, statement of owner's investment. These are all, they sound similar to statement of stockholders' equity. But the important thing to know is that it's a statement about all equity, not just owner's investment would be just one component, or which is equivalent to common stock. Just it's one component of stockholders' equity. So that's how this question's trying to trick you, by making you think that, because it sounds similar to stockholders' equity. It might be important also to know what the kind of alternative namings are. Like balance sheet, like we said before, sometimes called the statement of position, and income statement would be statement of change. Income statement and balance sheet are kind of the most important. Well, important's probably wrong. They're the most common. Also, you'll hear income statement called the P&L. So the P&L, which stands for profit and loss statement. Because when you think about the income statement, there's revenue and expense. And depending on what those are, you're going to have a profit, a net profit, or a net loss, which is a way of describing net income. So net income is what revenue minus expenses are, and profit is what net income is when it's positive, and loss is what you call net income when it's a loss. Not to be confused with gains and losses, which is how you describe, net positive value increase or decrease on assets that are not in operations. So anyways, we could go down that rabbit hole. But so this question could be stated, what are the 4 financial statements and how are they? If we were trying to dissect this and figure out, hey, if you were going to see something like this on a quiz or a test, how will they try to trick you? One of those things. All right. Okay, so maybe that's overkill, but let's keep going. This is all just learning. Stakeholders are less likely to include which of the following groups? So, who are stakeholders? So, how do we define a stakeholder? Well, let's just check the glossary, see how it defines stakeholder. So, a stakeholder is someone affected by decisions made by the company. May include, I don't know if I care about the may include part right now. So it's someone affected by decisions made by the company. I'm going to delete this for right now. Okay. Owners. I call them stakeholders, but I'm guessing that this, let's go to the section of the book talking about this. Man. It's hard to navigate. Before exploring the specific, important to know. So over here, I'd say, okay, stakeholders. I guess let's make a section for stakeholders. All right, someone affected by the decisions made by the company. Haven't decided how much I like that definition yet. So the things to know here are the purpose of accounting information is to provide relevant information to decision makers. So a stakeholder is somebody who's affected by those decisions. Exactly here. So examples of stakeholders include lenders, investors, vendors, employees, the communities. Stakeholders are interested in the performance for various reasons. It's not always financial. Okay, so what's this question that we're being asked? Stakeholders are less likely to include which of the following groups? Jeez, I really don't know if I'm sure what they are thinking the answers are. Because these are all stakeholders, they're all affected. I mean, no, owners are stakeholders, employees are stakeholders. I'm guessing of all of these, competitors are the least. If you're going to think about it as this connection between decisions are made by the company for benefit of the stakeholders, I'm going to say that. So through the lens of decisions are made by the company for the benefit of stakeholders. Is that true? The stakeholders' interest. So, what's the ethical way of doing it? So, I think that's probably, this would be the lens that you use. Decisions are made by the company for the benefit of the stakeholders. If you buy into that idea, then who is the company trying to benefit? Owners, yes. Employees, yes. Community leaders, yes. Competitors, not as much. So I would say D. Okay. That's fun. Next question. Identify the correct components of the income statement. Whoa. So, I think the way I would explain this is to pretty much just define all of these terms in terms of my picture. So let's try to place all of them somewhere. So this version of the picture, this is the level 2 version of it. All right, so revenues, expense. I guess I should probably enhance this even more to have another section where I say gain and loss. Just quick aside, the reason for that is these are operating and these are other, non-operating. So revenues, losses, expenses, and gains are all part of the income statement. Then you've got assets, liabilities, owner's equity, revenue, expenses, investments by owners. So inside of owner's equity, I'll have I'll show it like this, where we'll have, I'll call them distributions or dividends. And these are contributions or common stock. I'll just say stock. And then I'm going to call this retained earnings and net income. So what was the term they used? Investment by owners is contributions or stock. Distributions. So revenues, expenses, I mean, that answer's all over the place. Revenues over here, expenses, investments by owners. So then D, assets, liabilities, and dividends. So that's all over the place. Anyways, so obviously the answer is A, because that's all the components of the income statement. All right, cool. All right, the balance sheet lists which of the following? So this is going to be the same exercise as we just did. Okay, so hit the picture again. The balance sheet assets, liabilities, owner's equity. So obviously it's that one. Revenues, expense, gains, losses. It's not that one, because this is the balance sheet. That's the income statement. Assets, liabilities, and investment by owners. So there it is again, trying to trick you. This does not equal equity. It's just one part of it. Equity is made up of investment, dividends, retained earnings, net income. Revenues, so it's not that one. Revenues, expense, gains, and distribution to owners is that. So, not that. So, A. Not what I wanted. Not what I wanted. What are we on, 5? Assume a company has 350 credit, non-cash sale. How would the transaction appear if the business used accrual accounting? Oops, wrong button. Oh, yeah. Okay. So let's remember what's in play here is accrual versus cash. So step 1 is understand accrual versus cash. So this is talking accrual accounting. So that means that cash and recognition are different. So a credit sale. So if there's a credit sale, that means, let's use cash, yes, no, recognition, yes, no. This is nothing. If there is cash and recognition, then you have debit, revenue, or expense, or let's just say revenue or expense and cash. If you have credit, so you have a sale, that means that yes, there's a sale, but no cash. That means instead of cash, you're going to have AR. And revenue. If you have cash, yes. Cash. And then let's just say deferral. Some deferral account. All right. So if we know that graphic, then we can come here and say, okay, in accrual accounting, recognition, yes, cash, no. That means it's an accrual. So there's not going to be where do I have that? I have a graphic. Okay, so where is 350 going to show up? It's going to show up on the balance sheet as a receivable, so not as a sale. It would show up on the income statement as a sale, so there's a problem with this one. That one sounds good. 350 would show up on the statement of cash flow as a cash outflow. Well, this is a no cash flow yet. Unless this is getting tricky and talking about adding back between, our income to cash reconciliation. I don't know if that's what it's doing. That would be tricky. The transaction would not be reported because the cash was not exchanged. Well, the whole point of accrual accounting is to report it. even though there was no cash exchanged. So it's not that. So the answer is B. All right, so we need a good graphic for all the accrual deferral, which I do have. Let me pull it up. Where is it? Hold up. Huh. Wait, maybe it's right here. No. Where did I just have that graphic? Oh, here. This graphic. Let me zoom out. All right, so we need to go through this graphic to answer that question, where I'm going to have to make a whole bunch of explanations of this, but this basically explains to you in an accrual or deferral situation how it affects the balance sheet or the income statement over here. Raise up the desk. All right, so anyways, that's how we would explain that one. Next. Which of the following statements is true? Tangible assets lack physical substance. Tangible assets will be consumed in a year or less. Tangible assets has physical substance. Tangible assets will be consumed in over a year. So, two things going on here. They're trying to identify if you understand the concept of how in the balance sheet, when there's assets. Will this work? Oh, sweet. Zoom in. When there's assets, there's the concept of short-term range and long-term. The way that assets are ordered on the balance sheet, because on the balance sheet you're going to have a whole bunch of different accounts, They're ordered in order of liquidity. And short term first, long term are next. And short term are anything that you expect to realize the value of, like convert to cash, be sold. Let's say monetize within 1 year, and then anything longer is long term. So when this is talking about consumed in a year or less, or consumed in over a year, these are definitions of short term versus long term. Well, if I draw the balance sheet again, say these are assets, another way that assets can be divided is tangible and intangible, which is just like the term sounds. Tangible means that it's physical substance. So, no physical substance, yes physical substance. So this is trying to see if you're going to mix up liquidity with tangibility. So, tangible assets, they do have physical substance. So, it's not that, because these are talking about liquidity or what short or long term. So, this statement, tangible assets have physical substance, is a true statement. So we know that one is C. Owners have no personal liability. Okay, well, this question's kind of getting out of the scope of my intro course. Maybe. Probably. I don't know if I want to get into this. This is more advanced. Yeah, I'm probably not going to include this, but just since I'm here and since it's interesting. Any kind of legal structure or any structure of a business will have two main considerations: legal and tax. And depending on the legal considerations you have, you'll choose a different formation, a legal structure. Let's make this big. So, the main legal consideration is liability. Man, my eye's watering. Oops. The main thing with liability is you either have unlimited all the way to limited liability, and also so legal liability and what you have at risk. Well, a corporation is when it's a separate entity from you. This is a form of liability. Like, this is very much limited liability. Your liability is limited to, well, you always have some liability. I don't know if this is trying to, because if you do something negligent or illegal, then you have liability. But in terms of the definition of these things, is a corporation has limited liability. A partnership, I disagree with them putting the term partnership there, because legally this needs to be defined as either a general partnership or a limited partnership, or even different. I like to say that the term partnership, just quote unquote partnership, is actually a tax. A tax structure. So if this means general partnership, that's unlimited liability. It's actually more liability than a sole proprietorship, because in a general partnership you're actually liable for your partner's actions, which is crazy. This says no personal liability. I feel like the answer is A, but they could be getting tricky, and it would be D. It's definitely not B or C. Let's look at the text and see if it says it anywhere. Let's get into chapter 3. Entity, legal structure. This is where we want to be. The concept of equity does not change depending on legal structure. That's right. But in different legal structures, it will be called different things. I think it would actually be cool to make a graphic that explains that, because that's something usually overlooked. The concept of equity in different structures. So this would need to be a table. Maybe it's like okay, structure. What are contributions called? What are distributions called? Retained earnings. So, for example, most examples in all these books are all talking about corporations, whereas so there's all these different formations where corporations' contribution called common stock, or owners' investment. You've heard them called distributions are called dividends, whereas in others, I kind of want to just say, I'm going to do a catch-all for now, where we can get more crap. So people call them draws, distributions, contributions, capital, initial capital. There's all these terms. You also colloquially hear people call them just capital accounts. Where's my text? I want to insert text. Whatever. Okay. Point is, we need to come back to that. All right, back over here. So this is talking about legal structure, terminology changed slightly depending on the type of entity, capital transactions, common stock. So everything I was just talking about. An owner draw. Where's it talk about liability? All right, let's search for limited. I don't like this question. Okay, well, I don't know what they want the answer to be, but if this is trying to make the comment that, hey, there's no absolutes in anything, then yes, it's D. But if they're saying, hey, which entity do you choose if you want to limit your liability, then it's corporation. So, dumb question. All right. The accounting equation. Didn't we just do this? Okay, so how will they try and trick? Assets. Well, we know that assets equals liabilities plus equity. So if you were going to rearrange that, can this be arranged as assets equals liabilities plus equity? You could minus liability from both sides. So assets, no, that's not what that is. So let's place each of these things. So we've got assets, liabilities, and equity. You've got non-current assets, current assets. So assets minus non-current assets would be current assets. So that's dumb. Assets plus liabilities is dumb. Assets equals liabilities plus investment by owners. Trying to trick you again. It's investment by owners is one of the boxes in equity. Assets equals liabilities plus owners equity. That's the correct answer. Don't get tricked. So I think what we need to have is a real focus on what is the equity box, which is owner, cash, out, owner cash in, prior earnings to date, or don't say to date. Prior earnings, current earnings, all right, so if we're going to go with that, you know, the other terms for this are draw, dividend, distributions. These are common stock, owner's investment, contributions, retained earnings, net income. All right, so when this, every time this says investment by owners, it's just talking about that box only, not the whole box. Don't get tricked. All right, which of the following decreases owner's equity? All right, so we know that owner's equity has cash out, cash in, prior, current. All right, which of the following decreases owner's equity? Well, investment by owners makes equity go up. Losses makes equity go down. Gains makes equity go up. So maybe we draw it like this. Because all this net income is this box right there. Hold up. All right, so you think of this box as just revenues and expenses and gains and losses. Revenue, expense, gain, loss. So investment by owners, make it go up. Losses, make it go down. Gains, make it go up. And a short-term loan is just a liability. Liabilities' existence don't make equity go down. So, decrease. Nope. 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 Yep. All right. Next. Exchanges of assets for assets have what effect on equity? Well, if this asset goes up for the same amount that this one goes down, the total has not changed. No change. So there's no change on the other side. So it doesn't increase equity. To increase equity, assets would have to go up and liabilities stay the same. That would increase equity. Geez. Okay, it's not decrease because assets would have to go down and liabilities stay the same. Oops. Now, when this says may have no impact on equity, I mean, that's true. So when this says exchange asset for asset, is there an assumption that their values are the same? Because if their values are the same, then there's no effect on equity. This statement, there is no relationship between assets and equity. That's crazy. I don't know how you justify that one. How could that be? What is this trying to do? It's weird. No idea how they're rationalizing that. I mean, the closest thing would be B, because in theory it could if they're different values. So I would say it's B, but that's tricky. Well, I just don't know what they're getting at, what thing they're trying to quiz you on. All right. All the following increase owner's equity except for which one? All right. What increases owner's equity? Gains? Yes. Investments by owners? Yes. Revenues? Yes. Except acquisition of assets by incurring liabilities. So that's an asset going up, a liability going up, not equity. So D, final answer. Trying to decide. Okay, so let's do 12. Which of the following is not an element of the financial statements? Well, okay. This could be interesting. So the financial statements, there's the 4 financial statements that everyone likes to talk about, which I need to think of a graphic. I mean, the way I've done it is to say it's your balance sheet, it's your income statement, and then it's your cash flow statement and your statement of stockholders' equity. So, which of the following is not an element of the financial statements? Well, let's just go. We know assets are part of the balance sheet. So, it's not that. We know liabilities. We know equity. So these are all balance sheet. All of them are. So future potential sales price of inventory. Well, this gets into our realization and recognition principles. So recognition is like when you write it down. So your financial statements are going to have nothing unrecognized. So you could recognize unrealized gains. But recognition of unrealized gains so let me think if we want to get into that. I need room. So there is such thing as recognition of unrealized gains. So it's unrealized, but you're going to recognize it. Well, that's with gains. Gains are things that you have. I want a different color pencil. Gains are something you have on non-operating assets. Well, inventory is an operating asset. It's something, it's an asset that is used in operations, and operations is what creates revenues and expenses. So when you realize the potential sales price of inventory, that creates revenue, not gain. So I feel like we need to have some way of, let's make a new, what am I thinking? It's like, so this is the income statement. You've got revenue and expense that give you operating income. And then let's say this is other income. The whole thing gives you net income. But this is your gains and losses. Well, this whole thing is operating. So the things that create operating income is inventory, services, and then we'll call these investing activities. This is when you dispose of assets that are non-operating assets. Well, things that are not inventory, basically. So I want to go back and see how the book defines it, but we need to, I want to make some kind of chart like that that helps you identify like this line between the income statement. All right. This one looks complex. Which of the following is correct order? I realized my face is over. Boom. All right, there you go. Which of the following is correct order of preparing financial statements? What? What's the difference between these? All right, so income statement is in all of them. Statement of cash flows. Seems like that wouldn't be second. That you wouldn't. I have honestly no idea, but I'd guess it's D. I don't know. I didn't. Come on. What does this want us to think? Correct order of preparing. I mean, let's just think about where the dependencies are. Let's delete all this. Well, okay. Here's probably what it's getting at. Is you can't create the balance sheet. All right, I think I know what it's wanting. Okay, so the income statement flows into the balance sheet. So that has to be first. And you have to finish I mean, in theory, balance sheet you'd have to know equity. So you'd have to know I don't know. Just I don't like this question because they kind of I don't know what it's getting at. Okay, so anyways, we know income statements first. It can't be this because statement of cash flow, everything has to be done before you can do statement of cash flow because it draws on everything else. So, statement of cash flow being last, so it's either B or C. So it's a question of, does statement equity come before balance sheet? And I'm going to say yes because you'd have to have the statement of stockholders' equity figured out before you could build the balance sheet around it. So I'd guess B. I don't know why this question's important. I don't like it. So I don't like this question. So I reject it. But I guess if I went through and read the book, there may be a section where it explains why that's important, and I'll do that later. I'm tired, so let's just motor through this. How much? There's only a few left. Let's get through them. The 3 heading lines of financial statements typically include which of the following? Okay, now we're getting into I don't care territory. Okay, sure. Company, yes. Like A seems right. Yeah, you'd need to know the company. You'd need to know which statement. You need to know the time period for sure. I don't think you need to know that. You don't need to know that. I mean, unless it's audited, and then you care about the auditor, not the preparer. So, who cares about B? Yes, you need the statement title. Yes, you don't need the preparer. Okay, name of the auditor. Yeah, that could be good if there is an auditor. Fiscal year end. Most financials are not audited. I'm going to say it's A, but I don't know. I would say A. So someone figure out if I'm right. If it's D, then that's dumb because most financials are not audited. It'd be fun to have a group of people to argue about these answers with and go through and dissect them. Okay, which financial statement shows the financial performance of the company on a cash basis? I don't like I don't know if I like this question. Because the balance sheet could, if it's cash basis balance sheet. So, okay, so financial performance. How are you defining performance? Are you talking about the growth? Are you talking about the balance sheet health? Like the financial health versus performance. So if we're going to say performance is kind of talking about the change and not necessarily your structure, then let's go with that. If it's cash basis income statement, then obviously, if it's cash basis balance sheet, then obviously I'm going to rule out B. I think you could argue that C always is going to show you the cash basis income because it's taking accrual and adjusting it down to cash by showing you how you could arrive at cash basis from accrual by showing you the adjustments. So if I had to pick one, these A and D can show you the cash basis if there's no accruals and if it's cash basis. That being said, C will always show you performance on a cash basis. So I'm guessing that's where they want you to go with that. Two more. Let's do it. Motor through. We're learning a language. It's taxing on the brain. Embrace the pain of learning. Run. All right. This stool I'm sitting on is starting to hurt my back. Okay. Which financial statement shows the financial position of the company? Ooh, we know we like this. Ooh, that's not what we wanted. Position. So remember my whole graphic of you've got point A, point B, change. So statement of position and a statement of change. Statement of position is showing where you're at. So like your asset value is the y-axis and time is the x-axis. I mean, this one, there's not a lot to get into, except for that's just what a balance sheet's called, is a statement of position. So I hope that's the answer. All right, last one. All right. Asset utilization. Well, first of all, let's talk about what working capital is. So when you talk about assets, the way that these are ordered is in liquidity. Like how soon they turn over. So cash, most liquid, blah, 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 blah. Working capital is going to be all of your assets that are the most liquid. So if you've got a lot of liquid assets, what that means is that you're not going to run out of cash. So C seems right. The amount of non-current liabilities is not relevant, because that's saying just because you've got a lot of current assets doesn't mean you've got a lot of current liabilities. Those are not necessarily related. The amount of non-current assets. Well, I mean, this isn't talking about a ratio. So just because you have lots of working capital doesn't mean you can't have lots of non-current assets. So it's not that. Asset utilization that's talking about, hey, are you being a good steward of your assets? Are you utilizing them? Bad asset utilization would be having tons of cash that you do nothing with. Well, having lots of cash on hand doesn't necessarily mean you don't use it. Like, it is related to this potentially, but just by definition, it's really just talking about how much liquidity you have. Okay. These questions seem cool so far. Identify the 4 financials. We should be good at that by now. Oh, dumb thing. Define the term stakeholder. Revenues and gains. Why is that distinction important to stakeholders? We should come back to that. How do I highlight this? Boom. We didn't touch on that. Identify one similarity and one difference between expenses and losses. Same, so it's the same kind of question. Explain the concept of equity and identify some activities that affect equity of a business. I like that. Explain the difference between current and non-current assets and liabilities. We didn't go over that. We did 7. 8. I don't know if I want to include that in my basic. 10. I don't really like that, but I'll go look at it. Okay. Cool. Well, just looking ahead. So I'm thinking if I create my, let's go back to the plan real quick. Not that plan. Where? I can't find my PowerPoint from this morning. Huh. Anyways, the idea of using this course as kind of the basis and going through, I like it. Okay. All right. That's it for now. We're getting close. We're going to start pumping out some content. So this has been a lab session. It's time to call it a day. If I can. All right. Have fun.